Welcome to The Explainer. Today, we're putting on our professional equity analyst hats to uncover the mechanical reality behind valuing a company. We're going to step entirely away from the daily noise and hype of the stock market to conduct a rigorous, systematic valuation. Our target today? Spire Inc., a major player in the utility sector. We're crunching the actual numbers to find its true intrinsic value.
Okay, let's just dive right in by anchoring ourselves to Spire's last close price, which sits precisely at $90.41. Now, at this price, the market is assigning Spire a massive $5.343 billion market cap. But as an analyst, you know that a stock price is really just a hypothesis made by the crowd. Our job is to test that hypothesis and figure out if $90.41 is a hidden bargain or a really dangerous value trap. And that sets the stage for our central mystery.
To solve whether this price makes sense, we'll investigate using absolute, relative, and asset-based valuation models, and then deliver our final verdict. Step 1. Defining the Spire valuation mystery. In any professional valuation, the raw source data reveals the real story. And with Spire, we have a glaring contradiction staring us right in the face. On one hand, the company has an incredibly robust 22-year streak of consistently growing its dividends. Income investors absolutely love that. But you have to look at the flip side. It suffers from a severely negative 5.37% free cash flow yield. So what does that actually mean? It means the business is physically consuming more cash than it generates. How does a company continually pay out cash when its core operations are bleeding? That right there is our paradox. Now, since real-world SEC documents aren't perfect and leave some blanks, we transparently inject sensible defaults to make our financial models run accurately. So we're applying a conservative 2.5% terminal growth rate, a 5.5% market risk premium to calculate our cost of equity, and we'll be pulling in standard utility industry peers to build our framework. Moving on to Step 2, absolute valuation. With our assumptions locked in, we're shutting out the stock market entirely to focus on the intrinsic mechanics, the actual physical cash Spire generates. Our most reliable tool for this is the discounted cash flow, or DCF model. It projects future free cash flows and discounts them back to today's value using the company's weighted average cost of capital. That's essentially just the average rate the company pays to finance all its assets. But when we apply this standard model to Spire, we hit a massive brick wall.
Based on the absolute latest data, Spire's trailing 12-month free cash flow is negative $286.7 million. In fact, its 5-year free cash flow compound annual growth rate is exactly 0%. Because the firm is physically consuming way more cash than it generates, the standard DCF model mathematically breaks down. It straight up renders a fair value of not applicable. This forces us to pivot to alternative absolute models to find what this business is actually worth.
So let's pivot over to the dividend discount model, or DDM, to see how that builds our valuation. Since Spire pays a highly reliable dividend, we can calculate its intrinsic value based strictly on the present value of those expected future payouts. We take their current yield of 3.65% and factor in their steady 5-year dividend growth rate of 4.88%. But here's the catch. While this proves the dividend is historically reliable, leaning solely on the DDM is incredibly risky when a company has negative free cash flow. Why? Because those payouts are highly likely being funded by taking on more debt. Because our DCF and DDM models feel so fragile given these extreme cash constraints, we have to utilize the residual income model. To do this, we need to contrast Spire's soaring net income, which has grown at a staggering 23.9% over the last 5 years, against its completely stagnant cash flow generation of 0%. The residual income model starts with the book value of equity and adds future residual income, stripping out an equity charge. It's honestly the perfect tool for a utility company that shows high accounting earnings on paper but has very low physical cash in the bank. So, we run the numbers through this EPS-based fair value approach, looking strictly at earnings power rather than those flawed cash metrics. Our source data explicitly calculates Spire's intrinsic value at exactly $66.91 per share. Now, comparing this $66.91 intrinsic value to the current $90.41 market price reveals a deeply concerning negative 35.12% margin of safety. From a purely absolute earnings perspective, the math just doesn't support the current market premium.
Next up, Part 3, Relative Valuation.
If absolute valuation is like meticulously inspecting the foundation of a house, relative valuation is checking what the neighbors are selling theirs for. Let's evaluate the enterprise value to EBITDA metric. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. For utility companies carrying massive amounts of debt, standard earnings ratios get heavily skewed. This specific metric is fantastic because it strips away all the debt and tax noise to show us the raw, operational value of the business.
Let's look at the actual multiples. Spire has a trailing PE of 19.61, a forward PE of 17.83, a price-to-book ratio of 1.56, and an EV to EBITDA of 11.92. When we compare these trailing and forward multiples against standard utility sector averages, Spire appears totally fully valued, if not stretched. I mean, a PE nearing 20 for a utility company with negative cash flow, that strongly indicates the market is already pricing in a premium for that historical dividend streak, leaving virtually no room for multiple expansion.
All right, part 4, asset valuation.
Our final standalone investigative tool is asset valuation. This is the ultimate grounding exercise where we compute the net asset value to see what the raw, tangible parts of the business are worth if operations literally cease tomorrow. It's our absolute baseline floor. But remember those relative multiples we just looked at? Spire's price-to-book ratio of 1.56 already tells us the stock is trading at a 56% premium to the raw accounting value of its assets. So the absolute floor is substantially lower than $90.
The crucial point here is understanding exactly why that asset value is so constrained. Spire is highly leveraged with a debt-to-equity ratio of 1.56. And even more alarming for a pure asset valuation, its liquidity is terribly frail. They have a current ratio of 0.61 and a quick ratio of just 0.45. To put that into perspective, for every single dollar of bills due right now, they only have 45 cents of liquid assets to pay them. This heavy liability burden deeply dilutes the true net asset value per share.
Which brings us to part 5, the final intrinsic value.
Okay, it's time to step back and synthesize everything we found from our absolute, relative, and asset-based models. We are faced with a truly fascinating contradiction here. We have a beloved 22-year dividend streak, but severely negative cash flow. We see impressive net income growth, but it's burdened by heavy leverage and weak liquidity. So how do we actually distill this complex reality into a single, reliable target price?
Let's look at the summary. Because the cash flow model breaks down entirely and the raw asset value is heavily discounted by that massive debt load, we have to lean predominantly on the residual income or EPS fair value estimate. By weighting this earnings power approach the most heavily out of all our models, our synthesized intrinsic value for Spire centers firmly around the $66.91 mark. So, what's the final verdict? Overvalued. Based strictly on the mechanical reality of these valuation models, we have a clear answer. The current $90.41 price indicates significant overvaluation. The market is pricing in a perfection that the fundamental data simply does not support. When true intrinsic value sits around $66.91, buying in at $90 means you are buying with a negative margin of safety.
I'll leave you with this final thought to ponder as you review your own portfolio's true intrinsic value. Are investors so completely mesmerized by the illusion of a 22-year dividend streak that they're blindly paying a massive premium while completely ignoring the mechanical reality of negative free cash flows? Thank you so much for joining me on this explainer. Keep analyzing, keep questioning, and always look for the true intrinsic value.